Of all the asset classes we've covered in this series, Forex tends to be the one most retail traders approach in isolation. You pick a pair, you look at the chart, you look at the technicals. What tends to get overlooked is that currencies, and specifically the US dollar, sit at the center of almost every other market you trade. Understanding why changes how you read not just the Forex markets, but gold, commodities, cryptos, and equities as well. Before we get into it, if you're looking to start your investing journey in the UK with a head start, check out the link in the description for the best platform sign-up deals, including up to £500 in free shares. This is not financial advice and your capital is at risk. Start with a fact that most people trading financial markets never fully sit with. According to the Federal Reserve, the US dollar is involved in approximately 88% of all foreign exchange transactions worldwide. Central banks hold around 58% of their disclosed foreign exchange reserves in dollars, and roughly half of all international trade is invoiced in dollars, meaning that when a company in one country buys goods from another, even if neither country is the United States, there is a reasonable chance those goods are being priced and paid for in US dollars. That is the scale of the dollar's role in the global financial system. And it is why movements in the dollar do not stay contained to the Forex market. They transmit outward. The most direct relationship is with commodities. Gold, oil, copper. Most major commodities are priced globally in US dollars. When the dollar strengthens, those commodities become more expensive for buyers holding other currencies. That reduces international demand and prices tend to fall. When the dollar weakens, the reverse happens. Commodities become relatively cheaper for foreign buyers, demand increases, and the prices tend to rise. This is a key reason why gold and the dollar have historically tended to move inversely, as we covered in episode 2. From there, the transmission continues into something called commodity currencies. These are currencies whose value is closely tied to the price of the commodities their country exports. The Canadian dollar tracks crude oil closely because energy exports are a significant part of Canada's economy. The Australian dollar tracks iron ore, coal, and gold, with Australia's export revenue heavily influenced by commodity demand, particularly from China. The New Zealand dollar tracks global dairy prices, given the scale of New Zealand's agricultural exports. When oil rises, the Canadian dollar tends to strengthen. When iron ore demand from China slows, the Australian dollar tends to weaken. When the dollar strengthens across the board, it tends to simultaneously suppress commodity prices and therefore compress the currencies of the countries that export them. One macro force, multiple simultaneous effects. The second Forex mechanism worth understanding is something called the carry trade. This is where the interest rate differential between two countries creates capital flow that directly move currency pairs. The concept is straightforward. If one country has high interest rates and another has low interest rates, capital tends to flow towards the higher yielding currency. Investors borrow in the low rate currency. Historically, the Japanese yen has been the most common example, and they deploy that capital in the higher yielding currency, earning the difference. That buying pressure supports the higher yield currency and adds selling pressure to the lower yield one. The critical thing to understand about carry trades is what happens when they unwind. When market conditions deteriorate and risk appetite falls, those positions get closed quickly. Investors sell the high yield currency and buy back the funding currency, often the yen or the Swiss franc, and that can cause sharp, fast moves in currency pairs that on the surface look disconnected from any fundamental news. The August 2024 yen carry trade unwind is a recent example. A rapid unwinding of yen-funded positions triggered significant volatility across currencies, equities, and crypto simultaneously. So when you are looking at a Forex chart, you are rarely looking at something driven purely by that currency pair in isolation. You are looking at the product of interest rate differentials, commodity dynamics, dollar strength or weakness, and the positioning of large institutional capital across multiple markets. And this is where it connects back to everything else in this series. A strengthening dollar tends to pressure gold. It tends to suppress commodity currencies. It tends to reduce the appeal of risk assets, including crypto. A weakening dollar tends to support all of those in the opposite direction. The dollar is not just a Forex instrument. It is a barometer for the entire global risk environment. In the final video, we bring all of this together, gold, stocks, crypto, CPI, into one connected macro framework that explains how these markets relate to each other and what that actually means when you open a chart. Make sure you're subscribed. That one pulls the whole series together. If you have found today's episode useful, subscribing genuinely helps us keep making these videos. This information is not financial advice and is for educational purposes only. Always do your own research. Capital at risk.